Cheap EV stocks are the topic of today's presentation, in particular Fisker stock and ChargePoint stock, both of which have been in the news. So we're going to kick off today's presentation by eating some of our own dog food. And the artifacts that you see on this slide, these are all available to Nanalyze premium subscribers, who are the same people who helped us develop these tools. So the Nanalyze Disruptive Tech Stock Catalog, we built that alongside an institutional fund manager and an old lady in Florida who wanted us to provide her with a way to keep track of all the stocks that we covered. So what we can do is open this up and go to the delisted tab to look for exits. And if you filter on green technology, electric vehicle charging, and electric vehicles, you see there's 4 companies here. You have at the top Volta. So that was an EV charging firm that was acquired by Shell, so that's good for them. Probably not good for the retail investors who had invested in it. It likely exited at a much lower valuation than what the SPAC ascribed. Then you have Proterra. They were doing electric buses. They went bankrupt. And then Sono Motors also went bankrupt. And we did this piece. We've written about all these firms, but I wanted to highlight the piece on Sono Motors. And we said, perhaps what's most incredible is that 16,000 people plunked down a deposit on a solar-powered car with a mediocre range that's still in prototype phase, with a go-to market that's always just several years away. Anybody can build a prototype. Getting to production is the most difficult thing to do, and the fact that Fisker is producing vehicles, that's quite impressive. And then we went on to say about Sono Motors that investing in the firm was entirely out of the question. And it's not just because we don't invest in companies without revenues, it's because we believe this bad idea is going nowhere fast. And indeed, that was the case. Now what we can do is move over to the other tab, which lists 460 stocks that we cover. We can then do the same thing, filter on green technology, then the subcategory EV charging, electric vehicles. And in this case, what we did is we filtered on SPACs. And you can see to the right of that, there's some notes. So that's a concise description of how we feel about this firm. These firms, as you can tell on the left, their status avoiding for all of them means we wouldn't invest in any of these. What we have are 4 EV charging stocks and 8 EV stocks. What we can do next is using the Refinitiv plugin, we can immediately pull in price and market cap data and then calculate returns. You can see Livewire at the top there. That's quite surprising. We might have to go back and take another look at that firm. They're doing electric motorcycles. But then we go down the list and we see all the companies here have lost at least 50% of their value. And when it comes to Fisker and ChargePoint, they've lost 75% or more of their value. And the question here, is there value to be had in these stocks, or are these value traps? Now, the only time that we looked at Fisker was last year in this piece titled, "Is Searching for the Next Tesla Pointless?" It is. And we listed out all the EV companies, the aspiring Teslas of the world, and did an update on what their production numbers were looking like. And at that time, you can see Fisker had a stock price that was much higher than what it is today at $8.77. It says here, only a 4-digit number of units can be expected for 2022. So we're going to jump forward to today and see what they're actually doing. Before we do that, I wanted to ask your help. Help us grow this channel. So we don't run ads, which means that YouTube algos have no incentives to push our videos to the front. So when you like this video, it helps promote it. So please do that. If you're not subscribed to this channel, you should. We help people become better investors. So let's go on to looking at Fisker's latest 10Q. Well, there isn't one. And when you look at the SEC filing database, you see here it says, Fisker was unable to complete the preparation of its quarterly form for last quarter. And the reasoning here, the timing of the appointment of a new chief accounting officer effective November 6th and the departure of the former chief accounting officer effective October 27th delayed the completion of the company's financial statement. So there's some internal turmoil. When you see somebody exit, and the exit happens that quite quickly, and then the appointment right afterwards, it's usually not a good sign. These things, when they're planned, make sense, but when when it's a surprise for the market, you can see how the market will react there on the right. And I think this last statement is probably why the share price lost so much of its value so quickly. It says, in the course of completing the preparation of the report, the company has determined that it has material weaknesses in the company's internal control over financial reporting. What they're trying to do right now is figure out where all the bodies are buried after the last chief accounting officer left, and they need time to do that. So that's a big, big red flag. But let's talk about how the company is progressing. So they talk about spending a lot of money. So these Fisker lounges that they say serve existing and future customers seem to be taking a page out of NIO's playbook, where they use these shop storefronts in high traffic areas, i.e. very expensive real estate, to showcase their cars. And you see here they have these flagship lounges at the Grove in Los Angeles and in New York City as well, certainly costing them a pretty penny. They have customer locations now open in 10 countries, and I guess that was a surprise that they would try to expand internationally when they haven't even mastered their domestic market yet. That seems rather aggressive and perhaps not very prudent. They have plans to open a lounge in Shanghai in December and January. So they're going into the market, and you can see our previous pieces on Chinese EVs. I was in China last year. I'm here now as well, looking at Chinese electric vehicle companies, which are doing very well. And this is not a place that a new company like Fisker should be looking to compete. But all this translates into a lot of money being spent on sales and marketing. And they're also now delivering vehicles, so that's very positive. 4,725 Fisker Ocean vehicles were produced during last quarter, up from around 1,000 the previous quarter. So you need to pay attention to the difference between delivery and production. So just because you produce a vehicle doesn't mean that you're able to sell it. Delivery is when you actually deliver that vehicle to the customer, and then you can count that product as revenue. So they've delivered 1,097 vehicles in the same quarter. So they need to accelerate their delivery. And just days ago, they said that they announced a delivery of 107 vehicles on Thursday, November 16th, 2023. So they're accelerating that. It's great to see. They said the company achieved this milestone by executing a new distribution strategy, and that just involves having their employees drive the vehicles to the customer. So that's what they're doing now. The hope here for this company is that revenue growth can save them. It can begin generating positive operating cash flows so they can survive. It's very difficult to raise capital these days, and survival is everything. So when we look at their cash burn, this is an $874 million company. They have $625 million in cash with an additional $550 million they can draw against. They already have $1.1 billion in convertible notes on the balance sheet, so there's going to be a limit to how much money they can raise through convertible notes before investors start saying no. They expect this year to burn through $565 to $640 million. That's a lot. If we assume that same burn in 2024 and 2025, then they have 2 years left of runway. Then their debt comes due, and that's a problem. Now, it doesn't matter at all how cool this vehicle is. It matters if the company can survive. So we can start doing some back-of-the-napkin math. 4,725 vehicles produced last quarter would generate $331 million, or $1.3 billion a year. Now, the 9% gross margin, they actually have a positive gross margin when you take into account, or say you remove the impairment charge. They have a positive gross margin. That's great, which means that revenue would produce $119 million in gross profits. Now, that's just gross. Now you need to take into account operational expenses. So let's assume they can bring cash burn down by half. Does that seem likely? Maybe, if they get past all the CapEx and opening all these lounges and whatnot, although sales and marketing is certainly going to continue to be heavy as they try to compete with every other vehicle manufacturer out there. But if we assume they bring their cash burn down by half, that's around $280 million they need to cover. So production and deliveries would need to more than double before they can get close to break even, assuming current costs are halved. Then once that happens, they can stop having to raise capital and have a chance at thriving instead of just trying to survive. So if you're looking at Fisker as a potential investment, ask yourself what you're trying to accomplish, because if you're looking for the next Tesla, just invest in Tesla. If you want exposure to EVs that aren't Tesla, consider BYD. So they're the largest, if you include hybrids, EV maker in the world. There are other riskier options out there as well, but if you're speculating on purchasing depressed assets like Fisker at a better valuation, just beware of falling knives. In our opinion, the potential upside here doesn't compensate at all for the potential downside. We wouldn't touch Fisker with a 10-foot pole. Now that brings us to ChargePoint. You can see here, recently in the news, it says ChargePoint stock slumps to record low after revenue warning executive changes. So again, we see turmoil at the C-suite. So ChargePoint expects revenue to drop to between 108 and 113 million, below a previous forecast of between 150 and 165 million, owing, they say, to weak demand caused by delays in electric vehicle deliveries. Okay, fair enough. But the real problem here, I think, that may have caused that sharp drop, upwards of 30%, would be their chief executive officer being replaced and their CFO departing as well. So that's a problem when you see something like that. Now, our concerns around EV charging have always been how profitable this business could be. And we've looked at the various business models that these firms might adopt. You can see this article here we wrote about ChargePoint. It says, how profitable is EV charging? Now, we like their market leadership, but we find the uncertainty around the optimal EV charging business model too risky and the current margins too low. Again, the reward not sufficiently compensating for the risks that you need to take. There's a big gap here between gross profits and operating expenses. You can see that in the table there. The last quarter there, July of this year, that gross profit is way down because of a one-off impairment charge, so don't worry too much about that. Here we can see that they've broken down their revenues into three segments: networked charging systems, subscriptions, and other. And then you have the cost of revenue there, giving you the gross profit. But then look at, after that, these operating expenses. So even if you erased R&D, you still aren't even close to covering your sales and marketing and general and administrative. So they're burning a lot of cash, and that's a problem. So if we look at their cash flows and runway, we see that they have cash of approximately $397 million, and they're doing an at-the-market share offering, which means that they're selling more shares, driving the price of their shares down, diluting existing shareholders. They also have $150 million in revolving credit that remains undrawn. Now, these lower revenues that they've guided towards, those don't bode well for their cash needs. And if you look at their operating cash flows here over the past trailing 12 months, over $300 million, then they've got, a year and a half left. So this isn't a company that we'd look at investing in either. Now, the efficient market hypothesis says that all information is priced in at any given time. So when new events happen, then that's new information and the market reprices these stocks. That's what's happened. And negative price action isn't necessarily bad. That's par for the course with volatile tech stocks. But ask yourself this: are these problems temporary or systemic? And for Fisker, having a material weakness with a CFO departing and they're trying to figure out where the bodies are buried, that's something at a minimum I think you'd wait for the next 10Q filing to see what the aftermath looks like. Then at ChargePoint, this executive shakeup with two of the most important positions being vacated, at a minimum, you'd want to wait for that dust to settle and probably see what year-end results look like before even considering investing in a firm that already, even prior to this event, we wouldn't have touched. We certainly wouldn't now. The question is, why try to hunt for value when there are so many quality names to invest in? I've personally never understood why people do that. You should invest in companies, not stocks. And what I think happens is a lot of people on Twitter or these social media groups will find a company that's gotten its share price decimated and think that there's automatically value there. We wouldn't buy the dip for either of these stocks. So just to conclude, electric vehicle stocks have destroyed retail investors. Along with SPACs in general, I think we've covered close to 100 SPACs. They've all been, largely all been an absolute disaster. And we warned about both of these, and we're continuing to warn about the dangers of trying to catch falling knives. Now, if SPACs were a bad idea when it was easy to raise capital, they're an even worse idea now. So I'm going to put up another video here that you might find interesting. Before I do that, please click the Nanalyze logo on the right, subscribe to our channel. Thanks so much for taking the time to watch this today.